Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking about the industrial real estate market in the U.S. and industrial users. Now we're going to talk about REITs. REITs are a great way to invest in real estate, and we certainly work with REITs a lot in the commercial real estate industry. Please welcome my guest, Stephen Marks. He's Managing Director with Fitch Ratings. Stephen, thanks for joining us.
Michael, thank you very much for having me.
And Stephen, get us started. How did industrial REITs perform in 2014, say compared to other REITs and also compared to the market in general?
Sure. Short answer is not that well on a relative basis. They were, from a total return standpoint, industrial REITs were laggards in 2014. They returned 17%. That compares to 30% for the overall U.S. REIT sector, and that 17% compares to about 14% for the S&P 500 during 2014. And the underperformance was due primarily to supply concerns, particularly early in the year.
Okay, so they beat the market. But they
beat the market. They beat the overall S&P market, but they dramatically underperformed the broader REIT sector.
Okay, well that's interesting. So what's Fitch Ratings' outlook for industrial REITs moving forward?
Sure, and we look at things from the credit perspective, and so which may differ from how folks think about it from an equity standpoint. But in general, we have a positive outlook for the sector heading into 2015, driven by a couple of things. One is favorable property fundamentals, and the second thing is improving liquidity and what we view as pretty strong balance sheet management. From a fundamental standpoint, we think absorption is going to outpace completions, and that should result in pretty good fundamentals, especially as it relates to occupancies, leasing spreads, same-store NOI growth. We think all those are going to stay on a nice positive trajectory. The one risk we see is spec development, which has cropped up in the sector at given different points in time.
Okay, so if your outlook does include possibly an increase in the property values, these industrial properties that these REITs own?
Yeah. In general, we think that there will be continued cap rate compression and growth in underlying cash flows, and as long as cash flows do increase and cap rates continue to go down or even stay the same, then values will increase.
Mm-hmm. Okay. And what should investors think about when investing in REITs and industrial REITs today?
A couple things. Some of the major themes is that, and we spoke about that in terms of spec development, but development cycles in industrial are really short for this asset class, given that a property can be built so quickly. So looking at supply estimates by looking at permitting trends, which is typically a useful tool for other commercial real estate classes, may not be as useful for this asset class. And then second, related to that, despite the short development cycles, we have seen the supply-demand balance get out of sync in certain points in time.
Okay. And are some of these industrial REITs more in tune to not doing development and some more inclined to do development? And does that adjust maybe the ratings on various REITs?
That's actually a good question, Michael, and it's true. The publicly traded industrial REITs do cover the spectrum of some have fairly substantial development pipelines and legitimate platforms that they view as almost separate segments of their business, and others are more buy and hold and don't want to develop and don't want to take the leasing risk or some of the other risks, development risks and cost risks of development, and then naturally there are other companies that are sort of in the middle, and so it is one of those sectors where kind of different from a lot of other REIT sectors where some companies just have development capabilities and want to do it, and they think it's a meaningful part of their business, and others don't want to touch it at all.
Okay, we're talking with Stephen Marks with Fitch Ratings about the industrial real estate market. And what about manufacturing, Stephen? Are companies bringing manufacturing back to the U.S.? Is it really happening?
It's happening in bits and pieces, and it really depends on the sector and the location. We have seen certain types of manufacturing increase, particularly in the Midwest. But by and large, for sure, China is going to always going to remain a risk in terms of manufacturing and cost. But we have seen on the margin an increase in manufacturing volume and more onshoring back on U.S. soil.
Okay, and you mentioned China. How might global economic factors impact the U.S. industrial REIT market moving forward?
Well, more than any other sector, because industrial is an economically levered property type, which means that it's tied much more closely than other sectors to the broader economic growth trends. And Fitch is projecting, and to that point, Fitch is projecting GDP growth of roughly 3% in 2015 and another 3% in 2016, which should support good fundamentals in the sector.
Are you seeing more companies that are starting to feel confident about the economy and are starting to hire more people and develop more properties and grow?
We're seeing that more so on the tenant side than we are specifically on the REITs or on the developer side. I mean, certainly it is a symbiotic relationship. The industrial REITs are there to serve their tenants, and typically that could be either locally or globally. And there are REITs that focus more on a local basis, and a handful that do focus more globally. But it really depends on kind of tenant confidence and ultimately economic confidence. And like I say, because industrial is so economically levered, any sort of consumer confidence and then developer or commercial business confidence is going to result in better fundamentals for industrial.
Right. Yeah, we seem to see more confidence in some of the tenants that we're working with, and it's a good sign. But Stephen, what else might impact the industrial sector moving forward?
A couple of things. I mean, like anything in commercial real estate, location is critical. So you look at Dallas and Houston, and they've certainly been in the news more so in the last month, just given what's been happening with energy prices. But it does take a while for these sort of macro fundamentals to have an impact on commercial real estate. That there may be reduced demand for space, given some potential employment pullback in those markets, and certainly less capital deployment generally in Texas, which could have a dampening effect on commercial real estate and specifically industrial fundamentals.
Okay, and can you provide us any tips for our listeners and viewers related to the industrial market, maybe to the tenants or maybe to investors or REITs or bankers? How about a tip related to the sector?
Yeah, I'd say generally, I mean, there are macro factors and micro factors, but more so the sector is impacted by macro. So to the extent that the U.S. labor market is improving generally, the pullback in energy prices, while bad for specific markets, certainly in Texas, is good for the consumer. A strong U.S. dollar, all of those things put the U.S. economy on a good trajectory that should benefit the supply chain, and the e-commerce trend is certainly not slowing down. All these things are positive for industrial, and so not necessarily a tip, but more just an observation that this sector seems to be pretty well poised as long as supply can stay in check to have pretty good performance.
And you mentioned the e-commerce trend, and obviously that's affecting retail and industrial, I guess, more than other sectors. And so how do you expect that to impact both those sectors moving forward and the REITs?
Well, retail, it can be tricky because it depends on the nature of the retail. If it's the bricks and mortar space, that's certainly a place within retail that's certainly much more under pressure, given e-commerce and even segments within the bricks and mortar, whether it be books, electronics, things like that are more easily intermediated by e-commerce, could be more problematic. But other sectors, and certainly look at a company like Amazon or any e-commerce business, they're going to benefit from, or I should say, industrial will benefit from growth in those online businesses, just given that there's no physical presence really for those businesses, and so. It really does depend. The symbiotic relationship does exist, and industrial can take advantage of it if you're located in good places where e-commerce is strong.
Great. Stephen, thanks for joining us today. We appreciate it.
Michael, thank you very much.
We'll have more on the industrial market. We'll be right back. This is the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. FIU, Florida International University. Earn your master's in real estate in as little as 10 months without interrupting your career. Visit FIUonline.com. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit creshow.com.